Argentine oil company YPF announced February 1st that it has agreed to lower prices on diesel. The announcement comes in the wake of government accusations that fuel prices in Argentina have been cartelized and rumors that the government has been studying the renationalization of YPF. But YPF's troubles are unlikely to stop with this agreement, as Argentine governors are convening February 8th to urge oil producers to increase production. If oil producers don't comply, the provincial governments are threatening to revoke drilling concessions. All of this talk about fuel markets comes at a time when a great number of things have been changing in Argentina. New capital controls instituted in the wake of October presidential elections hit businesses hard by limiting access to U.S. dollars and blocking foreign companies from repatriating funds. A host of new controls over the media have been put in place over the past 2 months, which indicate that the government is concerned about its public image. Finally, and most importantly, the government is in the process of implementing subsidy cuts on a broad swath of goods and services. This is the clearest sign yet that the populist policies of the Fernandez government are exhausting government resources. The driving motivation of the Argentine government is to mitigate the effect of economic turmoil on the public. To do so, the government has a number of tools it controls directly, such as subsidies and direct cash transfers. These tactics have rapidly increased government spending since the end of the 2001-2002 economic crisis. According to government figures, public investments increased by 420% from 2003 to 2010 and tripled as a percentage of GDP. This trend was accelerated in the run-up to the October elections as government investments in popular social programs drove spending to unsustainable levels. With the global economic outlook dimming in light of Europe's financial woes, Argentina is preparing for a rough year. Belt-tightening measures have been made more urgent by a drought that has Argentine financial analysts estimating that the government may see a 15% drop in agricultural export tax revenues this year. In addition to its own spending programs, the government also relies on pressuring private Argentine businesses to guarantee high employment and low prices to the Argentine market. Argentine industry is often first to receive reduced supplies of natural gas in the winter to ensure that private consumers receive sufficient supplies. Other manufacturing supplies are subject to strict import restrictions. More broadly, the Argentine government is directly involved in the management of prices at which goods are sold and wages of unionized workers. The combination of these factors has reduced productivity, damaged balance sheets, and reduced the margin of error for businesses throughout the country. Furthermore, artificially low prices incentivize higher levels of consumption across the board. The most compelling example of the long-term impacts of this dynamic can be seen in the energy industry. Argentina has significant proven reserves of both natural gas and oil. However, despite reserves and some government subsidization, the business climate in Argentina, combined with the capital necessary to develop these reserves, has disincentivized additional investment in new production. Whereas Argentina has historically been a significant net exporter of natural gas, the country lost that status starting in 2007 and has made importing liquefied natural gas a priority for Argentine's state-owned energy company, Enarsa. But the government's ability to subsidize energy production is fading. Just last week, the government eliminated tax concessions on oil production in a move that was expected to increase oil prices by about 7 to 15%. It is not clear at this point if YPF's promise to keep prices low means that YPF will absorb that additional cost, or if the government has offered additional incentives. What is clear is that the Argentine government is engaged in a delicate attempt to balance the expectations of a population long grown used to subsidies with the dangers of a rapidly expanding government budget.